Alright, hey, what's up guys? Scott here again with a brand new video, and for this one I'll be giving you all a very clear demonstration as to why certain kinds of option trading strategies where, basically you only have to risk a very small amount of money to possibly make huge profits, huge returns. I'm sure you've seen these kinds of things being advertised all over YouTube or Instagram, etc., etc. But ultimately why these kinds of strategies are just nonsense and why in the long term they simply will not work. And so for this video here in particular, I'll be setting up a trade just like that, very small risk, huge potential profit here in American Airlines specifically. And I'll be using statistics and probabilities with the Analyze tab here in ThinkOrSwim to again prove why these kinds of strategies just will not work in the long term over many, many occurrences. Now quickly here before we get started, make sure you guys check out the description of this video below to see some very cool opportunities to get some free stocks with brokerages like Moomoo or Webull, Tastyworks as well. And then also for anybody who is interested in joining a very exclusive online community where you can learn how to successfully trade options, then you can now join my options trading Discord. So again, check out the description below to learn a lot more about that. And then finally here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join SKILLSHARE using those links, you'll get a full 1-month free trial. Alright guys, so now diving in here, and again, like I said, we'll take a look at American Airlines for this video. And so the kind of strategy I'll be using for this stock is going to be a directionally neutral option buying strategy because really when you get down to it, if you want the potential to have massive returns and risk a very small amount of money, you pretty much have to buy options. Right? Because ultimately financial markets are very efficient at pricing risk and rewards. So when you do buy options, you are already put at a disadvantage because of things like time decay, and of course because you are paying money up front to get into that position. And so because of that disadvantage, that's why option buying strategies typically always come with a much greater potential profit than option selling strategies. Right? Because unlike buying options, when you sell them, you collect money up front. And as long as those options expire worthless, which has a very high chance of doing so, then you are guaranteed to make a profit. So with option selling strategies, you always have a higher chance of profit, but a lower potential profit. So bottom line here, when you look at places like Wall Street Bets, for example, and you see some massive gains very quickly, it's always with option buying strategies, typically buying out of the money contracts, and then the stock moves in a massive way in their favor, and the returns are just multiplied by a huge factor. So therefore, with American Airlines here, let's go into the trade tab real quick and take a look at the option chain for this stock. And so let's go into the August 19th monthly expiration with only 11 days left to go. Because I do want to find some pretty cheap options here that I can use for my strategy. And so what you're going to see here is basically a combination of buying a call debit spread and then also selling a call credit spread to basically try and reduce the cost of putting on this trade. So even though this strategy does involve both buying and selling options, it's still going to end with a net debit that we have to pay to put on the position. So again, whenever you are paying a debit to place an option trade, that's going to give you a much higher potential profit. And again, also like I mentioned, this strategy is going to be mostly directionally neutral. So as you can see right now, American Airlines is at about $15 per share. So ultimately by the expiration date in 11 days, we want American Airlines to be somewhere around this same price. So therefore, what I'm going to do here is sell 2 contracts of the 15 strike call option. So down below is going to be the completed order. Again, 2 contracts, 15 strike call. And then also I'm going to buy 1 of the 14.5 strike calls and also buy 1 of the 15.5 strike calls. So again here, because I'm buying the 14.5 and selling the 15, this position right here, or this part of the position, is a call debit spread. And then because also I'm selling another 15 strike call and then buying the 15.5 strike call, this portion of the trade is a call credit spread. And so now looking down below with the entire order and looking at the prices in particular for these contracts, let's figure out the entire price for this position. So briefly, I will pull up the calculator. And so if we're going to sell 2 contracts of the 15 strike call for a credit of $57 each, we take 57 and multiply that by 2. That's 114. And then we subtract the debits paid for both of these long options here. So minus 88 and minus 36. So there you go. As you can see, the entire debit paid to put on this entire position down here is only $10. And this here also is the maximum possible loss you can take on this trade by the expiration date. You can only lose 10 bucks. That's it. Although, of course, if you wanted to risk maybe 100 bucks on this trade, then just multiply the number of contracts here by 10. Or if you wanted to risk 1,000 bucks, then multiply these contracts by 100, etc., etc. And so now at this point, let's go ahead and put this trade on the Analyze tab here in ThinkOrSwim and really take a deep look at the chance of payoff for this kind of strategy. All right, so here we go. This is the Analyze tab in ThinkOrSwim, and as you can see down below, this is the exact same position, and above that is the payoff diagram by the expiration date. So down below on the x-axis, we have a possible range of prices for American Airlines to be at, and then on the y-axis here, this shows you the possible profit or loss on the trade by the expiration date, depending on where American Airlines ends up. And so now here, there's a few very important things I want to point out and talk about on this chart. So number one, take note of these small red ticks down below. These are the break-even points on the trade, right? So basically, as long as American Airlines is anywhere between a price of about $14.60 to a high of about $15.40, anywhere in this range, basically, by the expiration date, you will make some amount of money. But of course, the main objective here is for American Airlines to end up by expiration basically at the exact same price at where it is right now, at around 15 bucks per share. Because at this point, right, as you can see in the chart, you would profit about almost 40 bucks on the trade. Which again, if you're risking only 10 bucks to make a possible almost 40, then you're basically trying to triple your money with this one position. So naturally, of course, this kind of strategy or something similar to it sounds very enticing, right? I mean, again, risk a very small amount of money to possibly 3x that money in just a very short period of time. But unfortunately, like I mentioned earlier, markets are very efficient at pricing risk and reward. So anytime you have a trade just like this, where the risk is very small, but the possible reward is huge or the profit is huge, then there has to be a very, very small chance of making that profit. Right? Because otherwise, everybody would make this exact kind of trade every day. I mean, for example, if there was an 80% chance of tripling your money with almost no risk involved, then this would be a guaranteed way to make money over time, over many, many occurrences. But of course, as we all know, trading options or just trading in general is extremely difficult, and most people lose money by doing this. So therefore, as I've said, there has to be a very efficient balance between risk and reward. So now back to our diagram here. As I've explained, these small red ticks are the break-even points, but also take note of these brown dashed lines right here. And then also these small percentages in between. So basically this entire range right here is the 1 standard deviation range for American Airlines by the August 19th expiration date, which you can see down here as well. These are the expirations for our position. And so bottom line, what this means here, a 1 standard deviation range means that there's about a 68% chance of American Airlines ending up anywhere within this range by the expiration date. So obviously this is a much, much wider range than the small range right here where you can only make money. And also, of course, keep in mind that if there's a 68% chance of this stock ending up in this much larger range by expiration, then that also means there's about a 32% chance of American Airlines ending up beyond this range here. So ultimately here, this means there's a very, very small probability of you actually even making a profit on this trade, let alone trying to triple your money in this one possible case right here. And in fact, if I take these small dashed lines and drag them over and match them up with our break-even points right there, and same thing on the other side, there we go. Now you can see right here with these small percentages, these are the actual probabilities of American Airlines ending up either in this range here or this range right here. So therefore, to figure out the exact probability of this stock ending up in the entire break-even point here, or the break-even point range, we simply have to add together these two probabilities. So real quick, we'll take out the calculator one last time. And so we'll take 8.6 plus 12.4 basically, 12.4, and that gives you 21%. So for this trade here, there's only a 21% chance of making any money on the trade. And then of course, the chance of basically tripling your money on the trade is almost 0%, right? Basically, you will almost never hit this target. So only a 21% chance of making any money on this trade, which means an 80% chance of losing money on this trade. Obviously, those are terrible, terrible odds, right? Basically, you have a better chance of going to an actual casino in Vegas and playing blackjack or roulette and having a better statistical chance of making money that way. But of course, also those games in casinos are intentionally designed such that if you play them on average many, many times, you are guaranteed to lose money. And this trade right here is not that dissimilar, right? So basically every 10 times you make this trade, 8 of those trades will be losses on average, and then only 2 of them will be profits. And chances are they'll be very small profits and not enough to compensate for all those losses. So bottom line, that's why, in my opinion, these kinds of strategies are not trading. This is simply just gambling, which is fine if that's what you want to do in the stock market and you recognize the fact that you are indeed gambling, then by all means, go for it. Obviously, the risk here is very small and the possible profits are very large. But for actual trading purposes, you need a strategy and just an overall approach, basically, that puts the odds in your favor, such that on average, over many, many trades and occurrences, you will steadily be making money. So again, making these kinds of trades just at whim, just like going to a casino and just spinning the roulette wheel at whim, or playing blackjack at whim and just having no real approach to the markets, you are basically destined to fail and lose money. So I'm not saying that these trades are impossible to make money with, but you have to have something else with your strategy that somehow tilts the odds back in your favor of making a profit. And in my opinion, the best way to do that with options is to use option selling strategies, because by design, when you sell out of the money contracts, for example, you already have a much, much higher chance of making a profit. It could be 60%, 70%, or higher than that of actually making money. And then you add to that other management and defense techniques to your strategy, and you can drastically put the odds in your favor. And so with that being said, that's going to do it here for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.